Hello, everybody, and welcome to Fix and Flip and the new construction loan module. I'm Michael Strasser, the CEO of Alpha Funding, and I'm joined today with the senior underwriter from Alpha Funding, Priscilla, and she's going to take us through everything you need to know about fix and flip loans, new construction loans in general, overview our products today, talk a little bit about the things you can do to make sure that you have the best experience trying to get your loan in, even take you through an example of what a loan looks like and leave you for some tips for the future. So I'm going to be in control of the slideshow today. I'm going to let Priscilla start. I'm going to go to the next slide, and we're going to learn a lot about fix and flip and new construction loans. So without further ado, Priscilla, take it away. Let's talk about overall program highlights on the fix and flip and new construction programs.
All right. Hello, everyone. My name is Priscilla. I'm here to guide you and help you and educate you through our programs so you can better understand, what we do and how we look at loans. So overall program highlights. So these types of loans are 12-month loans, interest-only payments, and no prepayment penalty. So what that means is you're in the loan for 12 months. The monthly interest payments are interest only. So basically it's annualized over 12 months. So you're not paying like a traditional mortgage where you are paying, you're only paying interest basically. So that's all you have to worry about because you're getting in and out of these loans. The goal is to be in and out of these in a quick amount of time because you're paying for the amount of time that you're in the loan. So that's also important to know. In regards to loan amounts, so we do have I wouldn't say it's a harsh $100,000 loan minimum, but anything underneath that, we do look at on a case by case. And the reason for that is, the smaller the loan amount, sometimes deals can be lopsided. So we just kind of dive into why the loan amount's lower. Is it worth you doing it? And, is the purchase price and the value of the property worth it in regards to what the budget is and how you can get it done? So maximum loan amount, people do ask that. We typically don't ever hit that maximum, but those bigger deals, anything over $1 million, we do, again, look at on a case by case, but have we done them? Absolutely. 5 million, I would say, is, the max threshold, but anything over that, willing to look at if, the deal makes sense. We do have multiple programs that I am looking at. So we do have a fix and flip program that we're going to focus on today, as well as a new construction program. Aside from that, we do have, in that same program parameter, we do have a 5+ multi-unit program, which would entail anything that's 5+, which is commercial. Don't get confused with a commercial property, but anything 5+ units can be considered the wording commercial. We do have new borrower programs. So if you are brand new, we do welcome that. And, we do spend an extra time with you, guiding you through, our process. If you are, a veteran and you do, a ton of these, obviously, it makes your process easier because you're familiar with it and, already, and the scene. So, and then another touching point is interest reserves may be required for these types of loans, and we will get into that in further slides.
All right, so let me break down a couple of questions that I have from what you just said. So I want to go back to where we're talking about interest-only payments. So is it interest-only payments on the total amount of the loan, or is it interest-only payments as the loan goes, as we draw out funds?
Okay, so that's a really good question. In most loan scenarios, and I say most because there are sometimes situations where a loan amount is too low or under a threshold of being low, like for example, under 150,000 loan amount. We are being charged, or the borrower is being charged interest on the outstanding loan balance. So that is what interest is being charged at closing. Whatever construction holdback funds there are, that money is being held in escrow, and there is no interest being charged on that until funds are drawn. So if a loan is a full boat loan, it's one term, then they're being charged interest on the total loan amount. If it is a non-full boat loan, being charged interest only on whatever is has been issued or dispersed.
So on your first example, so if I have a loan that's 200,000, and when I close the loan with us, day one, I borrowed $100,000 to on the loan. That starting from there, I'm paying my interest on $100,000. In 2 weeks, if I take a $10,000 draw, right, I'm now going to start paying interest on $110,000, correct?
Correct. Yeah.
So would you say this is advantageous because depending on how long the loan takes, you're not paying the full interest on the total loan amount throughout the life of the loan? So in theory, at the end of the day, you're always going to have, let's say you have a 10% loan, right? You're always going to have paid less than 10% on your loan because you're never paying the total amount of interest from when you start.
Correct.
Right? Okay. What are the scenarios? Like, what are the moments where someone might have to go into, like what you said, a full boat loan where they're paying interest on the total loan amount day one? When might that happen?
So I'll give two examples. One that I just touched on. So if the loan amount is on the lower end, and like I said before, under the $100,000 threshold, under 150,000, it's really looked at on a case by case, depending on a borrower's credit experience, where the property is, what type of property, is it rural? There's a lot of factors that go into how we determine if it is going to be a full boat loan. Obviously, we go into these loans wanting the best for our borrowers. So we're always going to try to not, charge that because it is advantageous to only be charged whatever's outstanding. It's like having a credit card. Would you be upset if someone tried charging you on your total credit line as opposed to what's outstanding? So again, always trying to get the best deal for the borrower. It is something that could potentially happen. So that's one scenario with it being low. Another scenario would be if a borrower is on the lower range for credit and maybe their experience is lighter, maybe they have some, red flags on their background or, things that we can work through, but things that are a bigger risk than a much more clean deal. So that might be a way for us to get an approval, for someone that might be a little bit more of a difficult scenario or a difficult, situation.
Okay, tying into that, talk to me about interest reserves, because I feel like where we may require an interest reserve is very similar to what you were just saying. Like maybe touch on some of those scenarios about when that may or may not be a thing.
Yes, so that would kind of go hand in hand with that sort of scenario, full boat, non-full boats. An interest reserve for some programs is required. And what that means is that 1 month, or just an example, 1 month interest reserve would be added to closing. So basically, the 1 month is calculated and that's added on the HUD at closing. It's not necessarily additional costs as like a down payment, but you're prepaying a month of your loan up front. So if, for example, you were to close in November, your first monthly payment would be due January 1st. If you had 1 month interest reserve, it would be due February 1st. So furthermore, why we want these interest reserves. An interest reserve is basically it can be used to offset risk in a borrower. Again, someone maybe has a 650 credit score, but they have 10 plus for experience. Maybe they missed a few payments, they got behind, they struggled a year and it affected their credit, haven't paid off maybe some credit card debt and it's affecting their credit. It's a scenario, that we would consider to maybe have like a 3 month in there just to feel a level of comfort for them to be making their payments. So
you would say really the interest reserves are really case by case. There's no like hard and fast rule about when they apply. It's really on the fringe areas of certain deals.
Yeah, it just depends what loan program we're putting you into. I would say for our 10% down program, it always is going to be a requirement typically. And then, and those one-off deals that we're looking at that, have situations involved with them. And that's in the sense of having a larger interest reserve. There's one program in particular that we do require an interest reserve in general. So it just depends what program it is.
Okay. All right, let's go on to the next slide. Let's see what's next. All right, let's talk about fix and flip loans. Tell us, break down kind of the general pieces about a fix and flip loan. If, by the way, if anybody's watching and you're trying to look for specifics like credit or other factors, we're not really going to touch on that here because those things can change literally next week, next month, by the time you watch this. So we're really going to try to, hone in on the general parameters. So if you're looking for what the minimum credit scores or FICOs are, please go to the website, check out of there. You'll be able to find the minimum FICOs and such there. You're not going to find it in this video because by the time you watch this, it could be massively different. So just want everybody to keep that in mind. But with that, break us down just like the general parameters of a fix and flip loan.
Okay, so fix and flip loans, basically, the goal of a fix and flip loan is to acquire, a property, rehab it, get you a future value of a property and then flip or refi out of the property. So our general down payment, I would say, varies between our very, very, very best borrowers with the most experience that have the potential to get 10% down of purchase price, as long as it's within our, our lending limits, which means as long as it's within a 70 AR LTV, 70% of the after repaired loan to value. We'll touch on that in a second, but so that's our best program. So what that means is basically the borrower is bringing 10% down of the purchase price to closing plus closing costs. As I mentioned on the last slide, so typically for this program, there is an interest reserve requirement. If your credit's great, probably bringing 1 month. Furthermore, the programs would break down into a 15% down program, 20% down, 25% and 30. Those are typically the program differences, I would say. And experience is a big factor in that, which we'll touch on further in the slides. I'll break down why that's super important, but that's basically what would vary the down payment that you are required to bring. We are always funding 100% of the rehab funding. So sometimes borrowers will ask, can I fund my own construction costs? So can you? Sure, you can. But we always have to have that money allocated for us in case something happens and you can't finish the project. So that money is there for basically us or someone else to pick up the project and complete it. So always funding 100% of the construction. If you want to use your own funds and you maybe want to take only one draw to take some of the money, that can be one scenario. You don't want to take any of the money at all, and you just float through the costs, you can do that. If you really want to get...
And that works based on what you said before, right? When you're saying that you're only paying interest on dollars you take. So we're making sure that dollars are available to get the deal done is what you're saying. That's the 100% rehab financing.
Mm-hmm.
But if you want to do the project with your own money, you can do it and you don't have to take out any of that money, and any of that money you don't take, you're not going to pay interest on, right?
Exactly. So it's a really good way to get creative. If you do have that money that you have on the side, if you want to put it on a credit card and then take one draw, pay off half of it, sell the property, pay off the other half. There's many different ways that you can do it and get creative to really, maximize what you're making and not use all of your money and leverage it. So
to recap, we 100% require the rehab funding to be part of the loan, but we do not require you to draw down any of the money.
Correct.
I want to reiterate that.
Yep.
Required to have it in the loan, not required to actually draw down any of the money.
Yes.
Perfect.
Yep. So the 70 AR LTV. So 70% for our programs currently is the maximum after repair loan to value. So 70% is that threshold that we're lending up to. And if it exceeds that, you're having to bring more money down. 65% may be looked at for newer borrowers or even for nationals. That is our cap there. But 70 is the max right now. And also, something to keep in mind with that 70 max, and if it does exceed that value, you do have to be careful that, the deal is profitable, because in most cases, when it is exceeding that 70%, it may be cutting into your profits. So profitability is an important piece to do on the front end due diligence, before submitting a deal, something that we also look at on our end, and we wouldn't, move the deal forward unless there was a clear exit.
I mean, obviously, if you're doing one of these deals, you have to make sure that the deal makes sense, right? You got to be making money. And that's something we're going to look at in this program and the other construction programs. We don't want to just do the deals and just loan you the money. We want to make sure the deal you're doing is possible, profitable, good for you, so that's good for us.
Exactly. Yeah, it's really, really crucial. And I think more recently, we really want to make sure that these deals make sense for you, because they do come, few and far between, and we want to make sure that it just makes sense for you. We're not looking to just, close a loan. We're looking for you to be successful and make a profit off of these. So it is something that we will discuss, on our borrower calls with you. If we do think that the deal doesn't really make sense, if we want to tweak any numbers, if there's, an ARV that, might be conservative versus, you're over guessing it. So there's just, there's different things that we are touching on, and that is one of them. Profitability is very important. And the last piece on here, so no experience, low experience options. But like I did say on the previous slide, we do welcome new borrowers. This program in particular, as I was going through the different down payment requirements, it is starting at 30% down of purchase. So you are required to bring a heavier down payment for your first loan. With that said, like we said, always funding 100% of the rehab and typically lending up to 65% of the ARLTV. So can we exceed that? Sure. If you have great credit, something we can fight for, to give you that maximum ARLTV. So
one thing I want to bring up here is you also had LTC here.
Yes, I did.
I just want to say, so like, for everybody to understand, so LTC is your loan to cost. And right now you're seeing ARLTV and you're seeing LTC. And they both matter a lot to these loans, right? So your loan to cost would be whatever your loan amount is, right? You're going to look at what your loan amount is and then what the actual cost of your deal is. So your purchase price plus your rehab. So even though, and tell me if I'm wrong, even though we'll go up to 70% ARLTV, if let's say we're looking at a loan at an 85 LTC maximum, that might only end up being a 60 ARLTV, right?
Yep.
So it's not always up to 70. You have to balance it out, right? So if you hit the LTC maximum, right, you're gonna may have to pare back your LTV, and vice versa. If you go up to the ARLTV maximum and then we're over the LTC maximums, you might have to pare that back as well. So just keep that in mind. Don't always look and be like, I can do 90 LTC and 70 ARLTV. Those two numbers have to marry each other. And just always make sure you realize that I think what people get hung up on very often is they see the big maximum number and they're like, everything is going to be the big maximum number. And you really got to make sure you're doing your diligence and understand how your specific deal works. And luckily, Priscilla, you're going to walk us through a deal in a little bit. So don't worry, everybody, as you get towards the end of this video, you're going to see Priscilla walk us through a deal and have that make a little more sense. So with that, we're going to move on to the next slide. Let's see what we're going to talk about next. New construction. So before I let you go crazy here, there's a lot of stuff we just talked about in the last slide. So maybe you just give us the high levels. Maybe just take us through the big general numbers, talk about some of that interesting stuff at the bottom there about what a modular build is, a stick build is, a block build is, and then we're going to touch more on some of these other pieces, especially the experience as we go through the video.
Absolutely. So yeah, like Michael said, we did touch on some of those numbers and how especially loan to cost in this scenario is very important as opposed to, basing it on a percentage of the purchase price. So why this program differs just, right off the bat from our fix and flip program is these types of deals are more of a high risk to get completed. They take longer. There's a lot more due diligence and just pieces that go into this type of loan. You're hiring most of the time a general contractor. You're getting permits, approvals. There's a lot more involved in these types of programs. So, for example, typically, we're at about an 85 LTC for this type of program. Let's just say that's our, one of our best scenarios. So 15% down of the purchase and the rehab is where you'd be starting at for that down payment. And like Michael was saying, up to 65 to 70% ARLTV. But that down payment is really crucial in these sort of scenarios because, again, riskier deal requires more of a down payment. When it comes to these as well, there are different types of new constructions. So modular is one that we get asked on a lot. A modular build is, basically a pre-built home that you are putting the foundation to. And it is being, you're usually getting a contract with a modular company and the home is coming, you see those on the highway. Sometimes you see the trucks coming with the house basically there already, and so it's coming in there.
It'll come in one or multiple pieces, right?
Yeah.
So I just don't want everybody to think like modular home. I don't want them to think mobile home, right? We're talking a full house that may come in 3 or 4 parts that a team is coming, dropping them all off and literally bolting them all together, right? Mm-hmm. Great. I just want to make sure because sometimes people hear modular and they're not always 100% sure what that means.
Yeah, definitely not a mobile home. Different from that. And
what
then
about stick builds?
And what?
What about stick builds?
Stick builds, it is I guess in my mind, a typical new construction program, foundation, and building.
It's wood, right?
You're wood, yeah. A frame.
Right, we're going to take sticks and we're going to build a house out of it.
Right, framing it and building it ground up.
Right. And block builds. So this one's a little bit new. This happens a lot in places like Florida and some of the hurricane bound states where block build, literally they're taking concrete blocks and you're building a house out of it for extra hurricane protection. Yes, we do fund them. It's like any other new construction for us. So really, really great stuff. And then the experience. I know we're going to really dig in on experience, but I just want you to give the real taste of what the experience difference is here as opposed to fix and flip. The first thing I see here is this is not new investor friendly.
Not a new investor friendly at the moment, but that could change with time. But right now for this program, we really want to see that you have a solid 3 previous deals of new construction or similar sized rehabs. So what that would mean is, you're providing us with a track record with 3 new construction projects that we can tie back to. I'll touch on, what that looks like and how we do that. And if you don't have a new construction, maybe you had an add a level, or you just added square footage and it had a similar sized project, something we can consider. We're not, nothing has to be hard in the box, but we definitely do need to see experience for these types of programs, for this program.
Or some kind of calculus between the two, right? Maybe you've done like 1 new construction and you have a portfolio of regular rehabs you've done, or you've done 2 new constructions or similar. Like you said, all you've ever done are heavy rehab add-a levels, and this is a natural next step. So you definitely need some kind of experience. You need some kind of similar experience. Doing this with no experience, definitely not going to work.
Mm-hmm. And just to add into that, having a general contracting license is very advantageous for situations like this. Let's say, you're on the cusp of a program and you do have two new construction deals and you've been a GC for 25 years, and maybe we can ask for some additional supporting documents, something that we can look at definitely on a case by case if there's a scenario like that. We are here to help work out deals and and provide you with a good experience and get you that loan closed. So definitely things to talk through.
Awesome. All right, let's move on. Ooh, this one for me touches to my heart. People who have seen me before, I love talking about this stuff, but Priscilla may love talking about it more than I do. And so take it away. Talk about tips for submitting a loan.
So this is arguably one of the most important things, processes, pieces of getting your loans.
On that. The underwriter is telling you this is one of the most important parts of your loan. So everything we just went through, we're talking numbers, we're talking percentages, we're talking down payments. Here is probably one of the most important parts of your loan, and that's straight from the underwriter.
Most important, and also if you're under a time constraint, it is really crucial to really just get us a clean deal submission, because the easier you're providing me information, the easier I can provide you with information, and the quicker too. So you'd think it's the most obvious, but the first step and the most obvious step is filling out an application in entirety and not leaving anything blank, unless you really don't understand something, understandable, but filling out an application in entirety and not leaving a personal financial statement blank, not leaving your social security blank, not especially
rehab amount blank,
not leaving the rehab amount blank.
That's really important, right?
Yes, very crucial. Because if I don't know what your construction is, that can differentiate which program we're putting you into. It's arguably one of the most important things next to your social security number or your personal financials. There's a lot of different. I would say that the whole entire application is important because it's taking your information and we're evaluating it to see which program you're best suited for. So something we're seeing often is putting your personal address versus what the subject property is. I don't want to underwrite on your personal home address. That does not, that doesn't do anything for me. I'm here to lend on your subject property, the house that you want to buy. That is, something that we're seeing right now that's getting mixed up a lot. Personal financials. Well, why are you asking for that information? Well, if we're lending you a ton of money, isn't that something that we should have a high level view of? Like conventional loans, we're not diving into your tax returns, for example. We're just looking for a high level understanding of what your personal financials look like, roughly, what's in the bank accounts, what your salary is. So that's really important. I'm
lending you $500,000. I want to know that you have the capability to make the interest payments that we set off to. Because if I lend you $500,000 tomorrow and you have no way of paying for it, that loan's going to go very bad very quickly and everybody's going to lose money, right?
Exactly. If you have no money, then you probably should figure out how to get that money.
Really hard to do a deal, right?
Yeah.
The one thing I want to say about the application, to what Priscilla's saying, is that at Alpha, what we've done is truly every question on the application matters to your deal. There's no fluff in that application. None. Everything that's on there matters to the evaluation and our ability to move your deal forward. So just always keep that in mind. When you're sitting there, you're like, why do I have to answer this question? You just need to know that question actually matters in our evaluation of your deal. Knowing what your rehab budget is truly matters in our evaluation of your deal. And maybe you don't want to submit that application if you have no idea what the rehab is going to be, because all that's going to do, it's going to tie up getting your loan moved forward, right? Know your deal, know what it is, fill out all the questions. And if you don't know, if you really don't understand, we're here for you. We're here. You can email, call, use our live chat, anything you need. You can always ask questions about what's on the applications, but always important, make sure you fill out everything you can and be as accurate as you can. There's a big difference between saying a budget's 100,000 and 200,000. It's not like, oh, you know, I thought it was 100 and now it's really going to be double. Like double's a big number. So just always make sure you're doing your diligence up front, filling out that application and making sure everything you put in is as accurate as you possibly can make it.
Exactly, because we're giving you a projection of what we can do pending, you know, the final appraisal, but we're giving you feedback based on what you're telling us. So if something's off, then we're not giving you accurate feedback. And we want to always, you know, be able to give you a clear understanding of what we can do. You know, purchase price should be a solid number unless, you know, something's changing.
If you're filling out the application with all this accurate information, you're getting a preliminary look at this deal from us within 24 to 48 hours. Mm-hmm. Not a week from now, not 4 days from now. If you're able to give us all the information in that application and be accurate, we are able to give you a great idea of what that loan is going to look like truly as fast as humanly possible.
Exactly. The cleaner the deal submission, the quicker the feedback I'm going to be able to give you. And if something is missing, then, you know, typically we're giving you a call or we're emailing you for that information. And, you know, maybe sometimes that person's unavailable, or maybe they missed the email or missed the phone call, or, you know, whatever the situation is, that's going to delay your process even further. So having a complete package, maybe not a complete package, but having a clean submission right off the bat is super helpful. To add on to that, you know, adding any supporting documents you have at that time of submission, you're basically getting one step ahead by submitting additional documents. So when I say that, you know, and we're going to go through that list of what that looks like. If you have a sales contract, go ahead and submit that. If you have your driver's license, go ahead and submit that. Bank statements, submit those. LLC docs, if you have that, go ahead and submit those. Those are really, you know, normal documents to submit for every loan. Furthermore, including a track record, which we're going to dive into a little bit more in depth in the next few slides, including your track record in your initial submission is probably almost as important as the application, because the track record tells the story of your experience for us, and it will decipher which program you can fit into. If you have, you know, one deal versus 3 deals, that will make a difference for the program that we are putting you into. So again, I'm here to give you the best idea of what we can do for you in the quickest way possible. And without those pieces for me to give you feedback, I'm unable to do that as quick as possible. So track record is super, super, super crucial. And whether it's our template that we can provide for you, or you have something similar that tells the story, you know, whatever you have, if you have HUDs available and you want to submit them right off the bat, go ahead. The more, the better in that sense.
I'm just going to take a pause. I just want everybody to let that sink in. Let this whole slide sink in. Let everything we just said sink in. One of the most important parts of getting your deal done. All right. Now let's move on to the next slide. You were talking about documents.
Here they are.
You said it. This is it.
Mm-hmm.
Maybe you don't go crazy through it, but tell us, like, maybe give us the highlights, right? Of like, what are like truly maybe the ones that trip people up the most.
So this is a full example list. Like you can see in the middle, you know, architect plans, not something that you would need for a fix and flip. So fix and flip general documents, you know, driver's license, bank statements, the track record, the sales contract. I mean, you know, that's an obvious thing. We need to see who you're purchasing it from, see the outline of that, you know, see who the seller, the buyer, the price, very important. Title commitment, you know, that is something that sometimes might not be available from the start. It would be something that your title company that you engage with would be providing to you or to your attorney or to myself directly. The itemized budget, that is another really crucial piece of information that we need for our loans. Alpha has a template that we do send out, and you are required, or your general contractor is required, to complete that budget. Basically, it's very easy. It's one column. You can tweak it as needed, and it's pretty self-explanatory. But that budget is what we're working off of for the life of your loan. So that is one of, again, arguably one of the most important pieces, because not only are we looking at that, but the appraiser is looking at that. The appraiser is using that to put together your appraisal and to put together comps, because what you're doing to a house is going to give you that future value. And that's what Alpha is lending against. So that is a really important piece.
I often say the budget is the Bible of your deal, because it permeates all the way through. You need it to get your appraisal done. You need it to figure out your loan amount. You need it to be able to get your draws all the way through your deal. Like, once you get that budget in, we lock it in on the appraisal. That is the budget for your deal. That is when you do your first draw, that's the budget we look at. That's the budget the inspection company looks at. That's the budget our servicing department looks at when they're calculating your draw. Your budget is the Bible of your deal, one of the most important things that you're going to submit with your loan.
Yep. So, with that said, having a general contractor do a walkthrough of a property is crucial to get you these numbers and to fill out this itemized budget. Before a closing, can things change? Sure. Can we adjust? Sure. But once you close, that's pretty much it. And you want to make sure that you put a lot of thought into the budget. If you need to add a contingency in there, which that's outlined on the budget Excel as well. But things, once we are reviewing the budget, that we can go through on our call. But yeah, it's very, very important to put a lot of thought into it, because if, if your line item, for example, for the roof, if it's 5,000 you have on there, but it's really 10,000, you're having to pay out of pocket that extra 5,000 if you are off on those numbers. So doing your due diligence up front and really conversing with a contractor that, you trust is really important.
So remember this is why she's bringing it up, is you're looking back at the highlights of some of these deals. For the most of these deals, we're going to push to get you as much dollars as we can up front. If your budget is wrong and you need more money later in the project, it's really hard to get you those additional dollars, because, hey, we're saying we're giving you the max leverage. We're giving you the max ARLTV. We're trying to give you the max loan amount based on the information you gave us. So if we're maxed all the way out up front and you need another $20,000, well, now we're not going to be inside those loan parameters, right? So it's really important to know, once you close on a loan, that budget is the Bible. That budget is not going to change. That is the gospel. It is the truth of your deal. So you always have to remember, do that diligence up front. Pay close attention to that budget. It's not a quick thing you just fill out in the Excel. You want to make sure that you have the right numbers to get your deal done. And that's one of the most important documents that you're ever going to submit on a deal.
Agreed.
Is there anything on here that you typically feel, Priscilla, trips people up? Any of these documents that, you say all the time comes through wrong? I know one that comes to my mind. And that's your insurance, people. Insurance is really hard. There's no other way I can say this. Insurance, in all things, is one of the most difficult pieces. Send it to us early. If you're working with an insurance company and you're getting a quote, send it to us as early in the project as possible. And if you want, we do have recommendations of people you can call and who know our programs, understand the type of loans that we make, and can help you do it. The number one thing, she puts it at the top of the list on purpose. It's the first thing on this list is insurance, is that this can be a thing that over the entire underwriting of your loan could be really difficult. So the sooner you start working on that, the better it's going to be for you to get this deal done.
Yes, that is something that can definitely hold up a closing. And like Michael said, sending that in early for our review so we can kind of critique it. We're happy to converse with your, your insurance company, insurance broker that you're using. We can, email back and forth with them, go through the quote, give them an exact understanding of what we need. And in addition to that, we do have documents that we send out with our initial email for our doc list. It's a sample form, and it is and also the insurance requirements PDF document. So you have a broker that you work with, you take those documents, you send it right to them, loop me on, and we'll kick it off early. But we often run into the issues with insurance holding up closings because for our type of lending, we do have very specific insurance requirements, and we tell them right off the bat what they are and give you the understanding of why we need them. So it's just crucial to get exactly what we need. And like we said, we have a list of companies that we've worked with for 8+ years that we know are reliable, can give us exactly what you need, and they are they give quick feedback too.
Fantastic. Is there anything else here you think you really need to touch on before we switch to the next slide?
Yeah, just really quickly. So obviously corporate formation documents is very important. We do not close in borrower names. We have to lend to an LLC, whether, you're providing us with, a traditional LLC or like a corporation, we can lend to either. We do have to collect those documents and review through them, including an operating agreement or bylaws, to see who the members are. If it is a 50-50 ownership, for example, we do need both of those borrowers on the loan as guarantors. So if, Bob submitted his application and he's wondering why we need that second, member on the LLC as part of the loan, it's because they are a member of that entity and we are lending to that entity with, furthermore has members part of it. And both of those members do have a percentage of ownership. So it is crucial to then submit that other application in so we can add that borrower onto the file. So are there scenarios where in some cases, depending on loan programs that, someone does not need to be part of a deal? Yes. And we would, furthermore discuss that once we are reviewing those corporate formation documents.
Okay. Am I good to go to the next slide?
I think that's it here.
All right, let's go on the next one. All right. I feel like I'm going to go sit down and take a little break and a breather while Priscilla talks about borrower experience. But honestly, so right now, and I'm going to say this in the fear that this could get stale very quickly, but right now, given the current climate, experience is one of the most important parts of doing a deal, right? Instantaneously, like she was just telling you in previous slides about having some experience is a massive difference in down payments. So, and the more experience you have, the more loan programs that become open to you. There's a 10% down program that's available to you if you've done a certain number of deals. Leverages get better as you do more deals. So there's so much there. So this is why the borrower experience is really, really important. And I'm going to say this, and I want to say it up front, and I'm going to let Priscilla talk about it as well. Simply telling us you've done a lot of deals does not help. It just doesn't. I'm excited that you feel like you've done a lot. I'm excited if you have done a lot, but it's really, really important that you have the documentation and the information that goes along with that. It's the only way we can consider the experience to help give you the best loan possible. Hey, listen, if you've done 15 deals, let's see it. That's going to make this loan easier for you. So it's really, really important not to skip over this. Even if you're a very experienced borrower, we understand. We understand nobody likes to do paperwork. I don't like to do paperwork. I do paperwork all day. I hate doing paperwork. But to get you the best programs possible, we got to do paperwork at least upfront, right? First time you do it, you're in the system. We have that information. But we got to just get over the hump of getting it in at least that first time. And with that, I'm going to let Priscilla take it away so she can talk a lot more in depth on borrower experience.
Yes. So borrowing experience could potentially change your loan amount from $300,000 to $400,000. It could get you more leverage and it could change your pricing. It could, lessen the money that you're bringing to closing. So there's not only the obvious, but, building your experience file out with us is really important. And we're only asking for these documents once. And like Michael was saying, who really likes to do, fill out documents and sift through old papers. But some people have actually said after doing so that they're happy that they did it because they organized their life a little bit more and everything is in one place and labeled. So you're only doing it once for us. But what these documents are, the Alpha track record, which we did touch on. So this track record is an Excel document that basically you're filling out the LLC you closed in. If you closed in an LLC, it can be your personal name, the property address, the type of property, when you purchased it and for how much, what the rehab was, and when you sold it and for how much. So that's really all we're asking in that document. It's giving us an overview of what you did. Sometimes people will put other people's experience under there. Don't do that. This is for you only. So that track record is just giving us a clean overview of what you've done.
And using somebody else's experience in the next bullet points that she's going through here, you're going to see why that's not going to work.
So
right? You could do it. That doesn't mean it's going to work. And she's going to tell you why right now.
If the borrower's on the deal, can you show their experience in the track record? Absolutely. If you had someone that you worked with 10 years ago and they are not on the deal, then that experience, if it's only their experience doesn't matter to us. So track record Excel, and then furthermore, 123 Main Street, you purchased and sold that last year. We would need that sale HUD settlement statement, closing disclosure. There's, different names for it, but that document at closing, that you're provided, that you're signing to tie into the sale of the property. And furthermore, if it closed under an LLC, we would need the operating agreement to show the ownership in that entity. If you had, a small ownership, but you still were part of that deal, that does count. So that's important. We do get creative in, talking through each one of your experiences to see, how we can confirm if it is, yours. If you can't find a HUD and you have a deed, something that absolutely we can make an exception for. So that's just one example. If it's not a property that you have flipped and you don't have a sale HUD for that because you're still holding on to the property, what you would be supplying us with is the purchase HUD or deed in that purchase. So now there's two different, obviously, types of situations, there could be more, but there's two different main types of situations with properties that you hold. You're either buying it turnkey and there is no rehab attached to that and you didn't, put any work into it. Or, you purchased it, you added value to it, and then you hold it and you rent it out. So in the situations where you did add, value and you did do some construction on that project, having supporting pictures to just show that work was completed will also be required to tie into, that project. So whether, it's one or two photos or maybe you have an appraisal, those documents are really important. So even if you supply us with 3, that will greatly help you if you supply us with nothing.
Even if they give you one deal makes a difference.
Yeah.
One completed deal makes a huge difference. Yeah. And on the picture part, what I wanted to say to this one was, imagine this, you're trying to tell me like how good you are at what you do, how great the projects you have, but you can't show me any of it. Like that's important, right? Like these are things that you naturally want to have in your portfolio, naturally have as part of a package that you have for yourself when you're doing deals, whether it's with Alpha or you're trying to raise private money or you're trying to do anything else. I want to be able to see like, oh yeah, Bob or Jane, yeah, look at that amazing house they built. Look at the finish work. Look at what they did. Absolutely, they're going to be able to take on this next project, right? So all of these things, that sounds like a lot, but these are things that you should be putting together anyways every time you do a deal.
Exactly. And like I said before, we are collecting these documents once, but if you are gaining experience and you do want to, update your track record to show us more deals, that will then get you a better leverage and a better pricing. So if you went from 3 to 6, that will greatly help you. If you're in that 6 to 10 range for flips in the past few years, you could be getting 10% down. I mean, that number is crazy.
10% down in this environment, 10% down. That is truly, truly incredible.
So that should be motivation to, track and keep everything organized, basically.
This is going to be one of the things that really sets your business apart from other people's, right? Organization in everything, and people talk about it all the time. Organization, everything is what's going to help you get to the next level. And here it's going to as well. The other thing I also want to make clear to everybody, you don't have to have done deals with Alpha for them to be useful. So like Priscilla was saying, like if you want to update your track record or you want to do something, if you've done deals without us, which is really sad, but it's okay, I understand. But if you've done deals before Alpha or since you've been using us, you've used somebody else or private money or anything else, update that track record. That all counts. All of it counts. They do not have to be deals that you've only done with Alpha. So just remember that. Every deal that you've done counts and makes a difference.
Yep. Super, super, super important.
All right.
And
if you're not, are you done?
No, that's it. Yeah, that's it.
On to the next slide. All right, let's talk about draws. I'm going to talk about draws because draws are near and dear to my heart. And I'm going to give Priscilla a break because she just talked all about track records. So draws. This is an important part to me, and in other videos you're going to find from Alpha, we're going to talk more about, kind of your post-loan process. But I say this because we were brought up budgets before, and that the post-closing part of your deal is almost truthfully as important as the beginning part of your deal, as everything up to closing. It truly is an equal balance. Draws are going to be the lifeblood of your project if you need our funds in order to fund your project, right? Things you have to remember. Funds are always released in arrears. What does that mean? That means you do the work, the property is inspected, we make sure the work that you want the money for is done, and then we send you the money. We do not send the money before work is done. And a lot of people are like, Mike, that's so crazy. I just took a construction loan. Why does that make sense? Because let's say you're using a general contractor and you want to take a draw of $10,000 and I give you $10,000 with no work being done. And you hand it to your general contractor and your general contractor goes to you, never picks up your phone and disappears and moves to Belize. Okay, well, I just gave you $10,000 out of your budget, which means you are now $10,000 behind in my work. So like, I can't give you more money, right? I can't give you an extra $10,000 now. We were just saying your budget's the Bible. That's what we have to work with. So we do this in order to ensure that the dollars that we're putting out are going to your project and the project is progressing forward, right? So this is really a thing that's not going to change. There's going to be no, sometimes we give the funds. Nope. Funds will always be in arrears, will always be for work completed. Next, an inspection of some kind is required. So what does that mean and why do I say of some kind? At the time of this recording for Alpha, an inspection by an inspection company where somebody comes out, looks at the project, takes pictures and gives us an assessment is required. There's a lot of technology in this space right now, and I can't tell you that's going to be that way forever. There's some new stuff where you can take pictures yourself and other things that are starting to happen. They haven't come industry-wide yet. So in order to make sure that we're providing you with as many programs as we possibly can, we're sticking with the old reliable for the moment of an inspector is going to come out to the property, take pictures, look at it, and give us a report and assessment to make sure everything that you say is done is done. Now, if they come out and you said the roof was done and the roof isn't done, they're going to tell us and you won't get money for the roof because it's not finished. It's that simple. That's that reimbursement upon confirmation of completed work. And the last part here about online, it's really easy. You're going to go to our website, you're going to click draw request, you're going to fill out a super short form of what's done, what's your project address, your banking info so that we can send you money, and we're off to the races. Typically within hours of that submission, your inspection order is made and the inspection company is going to reach out to you to schedule a time to come look at the property. The great thing is here, draws happen as quick as you want them to happen, right? So the inspectors typically call right away and they work on your schedule. So if it's a Monday and you can't meet them till Thursday, you got to wait till Thursday for them to come out and then 24 hours for them to give us a report. they call you on Monday and you say come out on Tuesday, and the inspector is like, hey, I can come out on Tuesday. Hey, getting that draw before the end of the week is looking better and better and better. So just remember, they're working also with your schedule. These are people who have to come out to the property and take a look at it. So draws, I typically say move as fast as you can in order to make sure inspectors can get out there. They typically turn around all their reports, truthfully, typically within 24 hours after they visited the property. So just keep that in mind. Draws, really important. These pieces are really important. Understanding that you don't get the rehab funds until that work is complete. So you have to either fund that first bit of work, or a lot of times the contractors will do the work and get paid upon completion, right? And it's really just to keep everybody honest. That's us keeping our borrowers honest, and it's you keeping your GCs or your contractors honest to make sure they're actually doing the work. So that in the small part is the draw process. Again, there's going to be later videos where we're going to talk about kind of post-closing situations, and we'll talk more about it. But I always find this is really important because a lot of time borrowers like, I didn't realize when I did this loan that I wouldn't get my construction money like right away. This is how it works, everybody. This is how you're going to access your construction funds. All right, moving on. Priscilla, senior underwriter Priscilla. Tell us what Alpha looks at when underwriting a hard money loan. What does that mean to you?
So this is basically a summary and a recap of what we just went over, right? So from the start, does the math make sense? We're looking at the numbers, the purchase price, the rehab, and the ARV. The loan amount, we're going through those numbers. We're looking at, again, purchase price, the rehab amount, how much cash in the deal, you bring to make that deal work. And furthermore, we're looking at those numbers to make sure there's profit, all things that we've touched on so far.
Expand on the profit part. You said it was important before. Tell us, if you give us an example of where you're typically looking for profits to be on a deal.
So let's say for a new borrower, I would say that, we have a threshold of what we're looking at to make sure that there's enough return for the borrower, so a 30% ROI. So, what we're considering high level when we're looking at those numbers is, how much it costs to be in the deal, and other factors like, the closing costs, the debt service, the realtor commissions. Those are high level what we're looking at to make sure that you're getting enough of a return. So if you're, putting down $20,000 and you're only making, $3,000 back, does that make sense? Just, it's just the obvious. Does that make sense to do that deal? Now, we can get really in depth with all the fees that are associated, but really high level, it's just important to just, get in and out of these deals because you're paying for the time that you're in the loan. So that's why we're looking at, the debt service, most importantly.
So just make sure you remember this, right? Your profit is real profit, not I took a loan out for this and I sold it for this. That's not profit, right? It's how much money did you put in the deal? How much debt service? How much interest payments did you make? How much did you pay for utilities while you went through the deal? How much do you have to pay that realtor when they sell it? You have to pay that commission, right? That's not profit to you. So sometimes a deal can look really juicy, oh, I'm going to make $50,000 on this deal. And then you start going, wait a second, I didn't calculate my payments. And then, oh man, I spent an extra, $4,000 in utilities. That's a big number right now. Don't anybody try to be crazy. Or, hey, I paid, $2,000 in insurance, or I had to pay an $8,000 realtor commission. You have to, now that $50,000 looks a lot more like $30,000. Right? And then you have to say to yourself, well, I put down $30,000, or I put down $50,000, I put down $60,000. Is that number right? And we're looking at it too, because as we've all seen, the real estate market can shift on a dime. One thing can happen and a lot of things can change. So you could go, if the market shifts a little bit, you could go from a $30,000 return to a $10,000 return. So it's always important to make sure that you're saying, hey, what's my profit in this deal, and is there a buffer? And we're looking at it too, because we're looking at it in the sense of saying, hey, we want to make sure you're successful in this loan. I want you to succeed. I have no desire to foreclose on any borrower. That's harder for me. There's no benefit for me. I don't want the property that you're rehabbing. I want you to rehab it and I want you to sell it to somebody and let them live in a happy home. I don't want it back. So this is a really important part of our diligence along with you. We want to make sure you're doing good deals and that you are successful in these deals.
Exactly. And just to kind of add to that, like we discussed earlier, you know, not only are we looking at one exit, we are, you know, can consider another exit if, you know, let's say the appraisal came in a little bit lighter than you anticipated, but, you know, the market is shifting and you really think you're going to get 400,000 as opposed to 300,000. If you're going to, you know, have the option either to rent it out or if that exit for a rental makes sense, we're going to go over those numbers with you and show you that, you know, it is profitable in another way as well. So that can get the deal done and make sense for you to get the deal done, or maybe give you a viewpoint of doing it, not flipping it and just wanting to hold it and holding it that way and making profit off of that as opposed to selling it. So things that we are going over, you know, once an appraisal is in and we have those hard numbers to kind of run through with you.
Amazing. And then we've already talked about experience. We're definitely looking at it. We already talked about now financial capability. We talked about this a little bit at the very, very beginning of the video. We're going to talk about it again now. Priscilla, I'm going to lend you money. What is it that I want to know because I'm lending you money that you're going to what? Well, pay me back. You looked at me like I was crazy. I'm lending you money. I want to make sure that my obligation is to lend you the money, right? Your obligation is to make your payments and pay me back, right? So when we look at financial capability and everyone goes, but you're hard money. I was like, yeah, I'm hard money, but I still want to make sure you're gonna make good on your obligation. You got to make those interest payments, those interest only payments every month. And you got to make sure you pay me back. Like those things are important. So when we're looking at financial capability, we're saying, hey, do you have a good track record of paying people back, right? And that's why we look at credit. That's us saying, hey, if you have a credit that's like 490, that might not be the best track record to say, I'm going to make sure it's really important to me that I pay you back for my loan. You know, if you want to get a loan for $500,000, but you have $5,000 in the bank and you're not sure how you're going to get the down payment to do the deal, that's something I'm going to look at. Or if you have just enough money scrounged together to do the deal, and then you're broke and have no money whatsoever to make your interest payments, we're stuck also. So we're going to look at that, and it's just common sense stuff. Like you wouldn't go lend anybody, any of your friends money if you didn't think they could pay you back. You wouldn't, if somebody came to you off the street and said, I had a great deal and I'm going to pay you, this is going to be great, I'm going to pay you this money, you're not going to be like, sure, and just hope they can do it, right? So this is an important part of underwriting. It's making sure that you have the capability to do the deal as well as do we have the capability to lend you the money, right? It's a symbiotic relationship. We both rely on each other to make sure that you can do the things and that I can do things and that we can work together to get them both done at the same time. All right, let's move on. Ooh, this is always my most favorite part of any presentation is when we can actually look at a sample of what a loan looks like. So Priscilla, I'm gonna let you take it away. Talk to us about this deal, maybe walk us through the important parts so people can see basically how a loan like this gets structured and what it looks like and the numbers that you typically look at when you're doing this deal.
Yeah, so this is, you know, a straightforward sort of fix and flip deal example. So you have a $200,000 purchase price, an $85,000 rehab, a ARV at $375,000, and 20% down is required. So how this shakes out, your total, so with 20% down, initially at closing, you're bringing that 40,000 to closing. Initially, we are funding 160,000 towards that $200,000 purchase price. So the difference between those two numbers gets you your down payment, which is 40,000. In total, if you are adding your initial fund that we're funding at closing, plus the rehab budget that we're funding, but it's being held back in escrow, that would total your total loan amount. So in this scenario, the total loan amount is $245,000. So 200,000 plus 85,000 less the 40,000. is, that's going into it backwards. But yeah, total loan amount, $245,000. And then furthermore, what we discussed earlier, ARLTV. So the percentage of this is the loan amount divided by the ARV. That's giving you a ARV of 65.33%.
So 245,000, your loan amount, divided by 375,000 means we're loaning you 65.33% of the end value of this property. Right?
Exactly. Mm-hmm.
So let's break it down a little. So this loan, we're looking at it, 20% of the purchase, right? Somebody's kind of in the middle of that situation. This right here is a cookie cutter deal, right? There's a lot of profit in this deal when you look at it, right? Because your all in is 285, right? There's $90,000 of potential profit. And when you chop that up with the other fees you have to pay along the way, right? You're at a number, depending on what state you're in, realtors, how long you're in the loan, there's a nice chunk of money vis-a-vis your initial investment in that loan, right? So that's always something to take into account. This sample is really great because it shows you the basics of how we do our calculations. On fix and flip and new construction, this isn't heavy math. There isn't a lot of crazy calculations. If you go back and you watch our DSCR module, I'm sure Dave will tell you about the crazier math there is on rental loans. Fix and flip, we try to keep it simple. New construction, we keep it as simple as possible. Purchase price plus rehab minus your cash in, boom, we get a loan amount. What's the ARLTV? Loan amount, divide by your end value, boom, we have an ARLTV. So, we try to keep it simple, and it's important. Don't overcomplicate a deal, right? Whenever I'm teaching any of the staff who comes up, Priscilla knows this, when I'm teaching people how to look at loans, I always say, when it comes to construction loans, take it to the basics. It will always work out when you take it back to the basics. Purchase price, rehab, ARV, dollars available. We'll always be able to figure out a deal with that. There's no way that you can ever get confused if you keep it to those basics. And that's really important because I understand you're watching this whole video, you're looking at, doing a loan. It can be really daunting. There's a lot here. But when you take it back to those basics, take it all the way back to the basics, you're always going to be able to figure out in the simplest way how a deal can look. Is there anything on the sample that we missed? Okay, let's go. Tips for real estate investors. So everything we talked about, super, super important. Building your team. Priscilla has talked about GCs a lot. Doing construction loans. GC, they kind of marry each other. If you're a GC yourself, that's amazing. If not, probably a good idea to get one. There's benefits in both directions, right? But making sure you have that, building your team, whether it's a lawyer, title companies we talked about, insurance companies we talked about, right? Lawyers to make sure that your corporate docs are together. All of these things, super, super important. Realtors, making sure you're understanding values, 100%. Make sure you have all of these things. Getting pre-approved. Okay, you know what's faster than doing your application correct, sending in all your documents, and having everything ready when you have a deal? Sending in an application and having all your information without a deal before you have one. What does that let us do? You get pre-approved with us. You fill out a pre-approval application. One of the lovely members of our staff will call you, we'll set up an appointment with you. They'll call you up on the phone, they'll talk to you. They're going to talk to you about who you are, your background info, your financial situation. We're going to sort all that out before you have a deal. Hey, maybe you need to raise a little bit more money. We can help you figure that out. Hey, maybe you need to work on your credit. We can help you, direct you on how to figure that out. That way, when you have the deal, you're just I know I'm ready to go with Alpha Funding. And I know when I have this deal, back to simple, my numbers work, my deal is going to get funded. Also, getting pre-approved allows you to have access to our proof of funds engine. So now I got pre-approved, I want to go make offers. You can go to alphafunding.com, go to the proof of funds site, fill out the information, have access to a proof of funds letter 7 days a week, make offers. Then whoever is looking at your offers can verify that right through our system and know that that's an authentic proof of funds. You get that by getting pre-approved. right? No reason not to do it. Make your life easier. We talk about, you're watching this video, so the next one makes sense to you. Always be learning, right? Always be advancing, always keep going. Lending doesn't stop. It's not always going to be the same. So I personally have been doing this for 10 years, and hard money lending, private money lending, what we do here looks incredibly different than the way it did in 2013. Just incredibly different. When I started as a slightly younger man doing this, doing loans looked incredibly different. Lastly, knowing your numbers, knowing what you're doing, we talked about that. Being prepared is the thing that makes a difference between getting a deal done quickly and getting a deal done slowly. There's no way to circumvent being prepared. If you are prepared, we are prepared to give you fast answers, quick turnaround, and everything you need to figure out a deal. When you're not prepared, it's going to be harder to get those answers. It's full stop. And taking action. When we, starting this process, getting pre-approved, super important. When you're submitting a deal, making sure you're following up on the emails, you're getting the documentation we asked for, all of these things, you have to do it. The patience involved with it. Sometimes things can't happen instantaneously. A lot has to go on. You have to be patient. You have to be patient with the process and know the process is going to work for you, right? Super important. With that, I want to thank Priscilla. Thank you so much for spending all of this time with me to talk about overviewing of construction loans. I just want everybody to know Priscilla's amazing. She's been with Alpha for a really, really long time. Most likely you will speak with her if you ever do a construction loan with our company. She's been incredible. There's a reason why she's our senior underwriter. She's incredibly smart. She's incredibly amazing. She's incredibly diligent. She knows how to get loans done. She knows how to get loans done better than I do. So I just want everybody to thank her for this. Thank you, Priscilla, for taking the time. And to everybody out there, watch this a couple times. Take the time, take it all in. Go get pre-approved. Talk with our staff, talk with Priscilla. Do this, start the process, get going. If you have questions that we didn't answer in this, always be happy to send an email to our general mailbox, info@alphafunding.com. Reach out, go to our website. We have FAQs, we have live chat, we have all the things you might need. If we didn't discuss something that you need more information on, I really, really hope this was great for you. I really, really hope you were able to understand more about construction loans, fix and flip new construction. We look forward to seeing deals from you. Again, thank you, Priscilla.
Thank you, everyone. Hopefully this was helpful.
And have a great, great time getting loans done. Go out there, go get them. Thanks.